The broadcast is now starting. All attendees are in listen-only mode.
I love it.
Good morning and welcome to the Texas Mortgage Bankers Association's 2022 and 2023 webinar series, a part of the Education and Endowment Committee this year led by me, Pam Jenkins, and Dave Toggenbaugh. I will be moderating today's webinar. This webinar should take about an hour, but feel free to ask questions throughout the webinar using the chat in the window. As always, if you have additional questions, you can email Carol at the email address on the slide on the screen. Today's panel, super informative topic. It includes Aaron D. with Loan People, Colin Luba with Texas Capital Bank, and Greg Richardson with Primis Mortgage. Forgive me while I read their bios. I did not memorize these, but I do know them all very well. You're going to love this. Aaron D. is currently the COO and co-founder of Loan People LLC. For 19 years, Aaron has worked in the mortgage lending in a wide range of capacities, including underwriting, compliance, secondary marketing, LOS administration, training, and operations management. Aaron participates in industry advocacy groups and is honored to serve on the Texas Mortgage Bankers Association Board of Directors. Aaron earned her BS in Finance with University Honors from the University of Central Florida and her MBA in Finance from Nova Southeastern University. Aaron, we're excited you're here.
Thank you.
Colin Luba serves as Executive Director, Credit Officer for Mortgage Finance at Texas Capital Bank. Having joined the organization in July of 2022, in this capacity, he oversees all frontline credit management of the bank's portfolio of warehouse, mortgage specialty lending, and EBO clients. Prior to Texas Capital, Colin spent 9 years with Plains Capital Bank, initially responsible for development of the South Central U.S. territory of the National Mortgage Warehouse Lending Division before assuming the role of credit officer. He currently serves on the board of directors for the Texas Mortgage Bankers Association and holds an accredited mortgage professionals designation from the Mortgage Bankers Association. He is a graduate of Southern Methodist University, earning a Bachelor of Science in Economics with Financial Application in the Southwestern Graduate School of Banking. Colin, thank you.
Of course. Happy to be here.
Thank you. Greg Richardson is Executive Vice President, Capital Markets at Primis Mortgage. Greg has over 30 years of financial services. Prior to working at Primis, Greg most recently served as the Chief Commercial Officer and Head of Capital Markets at MaxX in Atlanta, Georgia. Prior to that, Richardson successfully managed mortgage pipelines and other loan portfolios for some of the biggest players in the industry. Greg, thank you for being here.
Thanks so much. Super excited to be here.
If you don't mind, let's get started, Greg, by having you kind of introduce to the panel and to our attendees how your role applies to this topic of liquidity, and give them a little bit more of your background.
Yeah, sure. Greg Richardson, of course, and super excited to be here, and really passionate about the capital markets and secondary market. My career has all been about, well, as a kid, I was a CPA, but really it was all about trading, asset management, portfolio management, and joined Primis late last year, and along with Pam, and we're really excited about what we're doing at Primis. But the reality is the capital market side of this, really when it comes to liquidity, and it's absolutely important to understand the impact of liquidity in the capital market space. And I'm going to spend a little bit more time after this introduction to go into detail about the importance of having product breadth, investor breadth, capital markets transactions, who you deal with, etc. And so really looking forward to talking about this today. There's a lot of different places we can go in this conversation, but more important than anything else, liquidity, whether it's on the warehouse lending side to Colin or on the capital market side, it's absolutely critical and paramount to your success.
Yeah, certainly. No, Greg, thank you. I appreciate again the opportunity to be here and talk with you guys. I have to give my disclosure that I'm required to give, that this is really my thoughts and opinions on this, and doesn't necessarily represent those of my company. But what I want to really try to do and accomplish here with you guys today, give you a perspective from the warehouse lenders. Obviously, this is a conversation that we're having with every single one of our clients. It is a very relevant topic. And in particular, helping our clients to understand the value in their balance sheets. And our conversations are really focused around the breadth of the products that we are able to speak to as a bank in helping our clients determine where can they tap into the liquidity, kind of given the current market challenging times. So I would say overall, just as a general outlook from our client base, the conversations that we've been having have generally been for Q2 that, we've maybe flattened out in terms of, a consistent downward trend. We're starting to hear a lot of our clients are anticipating reporting either near break even or maybe even some slight profits in Q2. Obviously, that's not necessarily on the top line side, but I think a lot of that speaks to what they've been able to do in terms of cost cutting and capturing and consolidating overhead where possible. So I'm really excited to be here.
Awesome. I think I need to correct my bio. I actually, this month just hit my 21st year in the business. In labor years, that's 42. But I've bumped over that 20-year mark finally. So in my role working with an independent mortgage bank, for us, we don't have any other lines of business. Mortgage is what we do, and it's what we rely on. So, for me, I look at liquidity really in two pieces because I'm really heavily reliant on people like Colin or on the warehouse side to help provide the liquidity and getting our loans funded. And then on the investor side and getting our loans purchased for the best possible gain. So, first I need to make sure that my shop is running clean, profitable. I get good, clean loans. I turn my lines quickly so I can maximize my top end. And then I have to also look internally on a loan level day-to-day basis and make sure that my manufacturing process is one that, my loans are getting turned quickly. I'm not, incurring extensive fees for delayed purchase. I'm not, any of that would be leakage from my top line. I need to make sure I'm staffed properly to scale, and I need to make sure that, I'm getting as much value out of my vendors as possible. So for me, liquidity really is just kind of everything that I do from top to bottom.
That's fantastic. That's fantastic. When we were getting ready for the webinar, we put together several questions, and y'all sent me your comments back on this. And I think it's super cool, the three different perspectives we have here, like true capital markets, banking and warehouse, and then the IMBs. So I want to make sure we get all of those perspectives kind of drawn out in each of these questions. The first question, in the current economic climate, what are some effective strategies or best practices that lenders can employ to ensure sufficient liquidity in their operations? Greg, did you want to start with that one?
Yeah, that'd be great. If you can throw up a chart, because you can't talk to a secondary capital markets guy without a couple charts. But really, I just want to throw this up here real quickly. We all know rates are higher than they were certainly 2 years ago, but really this chart shows all the volatility we've experienced, quite frankly, in like the last 6 to 9 months. You can see we're currently right around 7%, slightly south of 7%. Week and a half ago, pre-CPI, we were at 7.25. So, from a capital markets perspective, hedging that interest rate risk and all the volatility, to Aaron's point, around gain on sale, our job is to, maximize the amount of originations, yet make sure we make money. And so, that's optimizing our gain on sale. And quite frankly, the way you really do that is to ensure you have, number one, great partners, investors that you can trust, that provide you the liquidity as you kind of go through these markets. And I really want, can you click down the next chart, because I want to focus on this for folks that don't probably think too much about this, and the impact of, most folks are always taught, hey, follow the 30-year mortgage versus the 10-year treasury. Well, the reality is generally they do go move in tandem. There is definitely a spread differential, although, most recently, the way you read this chart, there's kind of a horizontal line going through the middle there, slightly over 2. That's around 225 basis point. The blue chart is really where spreads have moved throughout the last 5 or 6 years. The far right side is basically where we are today. We're basically at historical highs on the 30-year mortgage rate versus the 10-year treasury, and that's about 300 basis points. So all else being equal, if there really truly was liquidity and real buyers in the mortgage-backed security space, we would expect that to trend more back to 225 basis points. So what does that mean to all of us? When the buyers come back, when the market settles down, we're back towards that average, and really that's about a 75 basis point difference in rates. So if we were at the average today, we wouldn't be at 6 3/4, we'd be at 6%. Now, I think I talked to a lot of our originators, a lot of people around the country in this space. The reality is there really hasn't been any real demand for mortgage-backed securities since 2022. Why is that? Well, the reality is banks have the issues that banks currently have in an inverted yield curve. Banks traditionally are the real buyer of mortgage-backed securities, as well as Asia. Both of them have more or less left the purchase space. And so what happens there is that spreads will go wider, as you see in this chart here. What does that mean to you from an origination perspective? Gosh, if the premiums that which used to be 104, 105, 106, and would always have a $103 price, 3-point premium on our rate sheet, those days are gone. 18 months ago, you started having discount points, and no one understood. Or you sit down and say, oh, I have to pay for my mortgage interest rate. Well, no one has seen that in 20 years. And so that paradigm has shifted, and really it's all been driven by the lack of liquidity in the mortgage-backed security space. No one wants to pay a premium in the bond world, number one, because the buyers aren't there. And number two, everyone thinks rates are going lower. Fed's going to be done soon. They're going to raise 25 basis points next week. Jury's out on what they're going to do after that. But everyone in their mindset, including real investors, don't want to pay premium for bonds when they think that they're going to prepay, because they lose money when that happens. So it's really put a ceiling on the premiums that anyone that are buying these mortgage-backed securities will actually pay. And so what that means to all of us on the origination side is originators, they make margin, and there's these things called LLPAs, low level price adjustments. When you combine those two components to a very small premium, you're never going to have a par price. You're never going to have something without a discount in today's world. That will change again when liquidity comes back, but the reality is, for the foreseeable future, that's just the environment we're going to be in. I know at Primis, when our originators are talking to borrowers, we don't even talk about a par rate, because the par rate is 100 basis points better or worse, than a 1-point discount. It's just because there's no interest in those premium funds. So we tend to sell a 1 discount point rate when our originators are out there talking to borrowers. So, and that's a material difference in rate between that and a par rate. So the reality is there's a lot of compression, there's not a lot of premium, and discount points for now are here to stay. And I really wanted you to see this picture and understand that dynamic, and really it's all driven by the lack of liquidity for mortgage-backed securities. So I'll stop there. I'll push it over to you, Colin.
Yeah, certainly. No, that's a great point, Greg. And I think to tack on to what the point that you're making is the general overall lack of liquidity in the secondary market has its trickle-down effect, right? I remember distinctly many of the conversations that we were having with our clients, really leading up until about June of last year was, well, how can we maximize top line, right? Where can we diversify, add different products and programs, anything to try to increase that top line margin that was already starting to compress. Around mid-year last year, those conversations changed dramatically to, okay, now what do we need to do on the expense side, right, of the P&L? And really all of that has to do with the fact of the lack of liquidity in that secondary market that is having its downward pressure and trickle down through the mortgage bankers, really their P&L. So, I guess my biggest comments around what we're going to discuss is really focused more so there. I look at it and I say over the last 2 to 3 years, we've had a remarkable run, if you exclude most of 2022, with regards to historical volumes in the industry and really, really strong margins. A lot of the conversations that we were hearing was, hey, I don't need to necessarily be concerned about shoring up leakage because I'm making so much on the top end that I don't have time to focus on the expense side, and I'm okay with that. I can afford that and absorb it. We need to get back to basics, and I liken this to taking a mindset of that person that's transitioning maybe from broker to banker and really growing an IMB. You're watching every single dollar that's coming into and out of your business. That's the mindset that even as a large organization, you can be taking to really try to shore up any leakage in your manufacturing process, to be able to minimize those expenses as much as possible. One of the key, and I think one of the best pieces of advice that I've ever heard in this industry from a gentleman, Mike McCauley, if you can't measure it, you can't manage it. So is there a way to, even if it's something that you develop internally, come up with a way to develop some way to manage the various aspects of your business, benchmark them, mark them, whatever you need to do. There's a lot of good industry best practices out there, but if it only works for you, come up with something and at least manage your own business there. Take stock in the partnerships that you have. Right now, I'm not sure that it's always the best practice to go out and start expanding into new partnership relationships. Explore ways to deepen those. Are there opportunities to deepen your breadth of touch with that particular partner, as opposed to trying to seek to add new ones to solve a problem? Our general guidance is you should have 2 to 3 sources of liquidity, and that goes not only for your investors for every single product that you originate, but also having multiple warehouse lines. You want to make sure that you're adequately covered, and that you've got the ability to tap those liquidity sources if your original plan doesn't go according to. And then finally, the last 2 points are really understand where there is value in your balance sheet. If you haven't done that in a long time, understand where that is, and start to have conversations with those people that can help you maybe maximize or leverage that value in your balance sheet. And then finally, volumes are way down. General, with the volatility in the market, take a look at your hedge. That generally tends to be an area where is there an opportunity to tighten, increase your breadth of reporting or your frequency of reporting to really try to tighten up that hedge and shore up any leakage that you might have in your hedge position as well.
Yeah, I'm going to tag onto some of what Colin said. I might disagree just a little bit on one point, but I think he makes some really good points. First specifically around the hedge piece of it, we frequently talk with our traders, with our hedge firms, to make sure that we understand every dollar that we get, every trade that's made. We're really diving into understanding what's expected versus what we're actually realizing. And your hedge reports, if you're not in them regularly as a leader, you're not doing your job, is quite frankly my opinion on that. On leakage, I also have to say this is huge. This is something that I dig into every single month. My CFO and my controller are my best friends. They do a great job of getting our financials together. So I'm able to sit there and dig into every number compared to what I expect it to be, compared to how is it trending? What are we spending on investor delayed purchase fees? What are we spending on any other sort of cure fees? So really understanding that, and even if you scrape an extra basis point or 2 here or there, that makes the difference right now. It really does. And also I want to talk about your pricing policy and your pricing concessions. You have to make sure that you have it really dialed in where your loan originators are able to deviate and how that works. Leverage the Optimal Blue automation for this to make sure that there is an approval process, and make sure you're looking at how much are they giving compared to what their comp is. This is kind of one of the first downturns that I've seen where comp has been on the table more than it has been. And we really need to understand how pricing exceptions and comp go hand in hand, and just be willing to have those conversations with our originators. I think that transparency goes a long way with this. We give our branch managers the ins and outs and every single charge, every single concession, every single everything, every single month. They have access to it on a real-time basis through our accounting system. And that's allowed them to partner with us in tough decisions that we have had to make, and it's really helped them understand the business a lot more as well, and they appreciate it. I think also talking about, to Greg's point, we can't do anything about certain things in this environment, specifically when you're talking about our premium pricing and the fact that it's basically non-existent right now. And so, we caught ahead of that early, and we had those very, again, frank conversations with our originators. You got to sell a point. You just do. That's the market that we're in. And instead of trying to talk around it or any of that, just live with what the market is giving you right now and find a way to succeed through it. The one area where, I do agree with Colin, it's very, very important to keep your relationships deep, and my warehouse banks, my investors, I love them. I think they're amazing partners to us, and obviously they are a big part of why we can do what we do every day. But I think in the last 18 months, we've seen that regardless of how good your relationships are, a board of directors who doesn't know your name can make a decision that completely changes your whole ability to operate like that. So we do keep an active bench of investors and warehouse banks that we're talking to should something happen that is out of our control. So yes, I completely agree on deepening relationships, but you got to build that bench because you never know when you're going to need to tag someone in. So I feel like I could talk for a full hour on this, so we'll spread it out over a few of your other questions, Pam.
And to just bounce off that, Erin, I completely agree with you. And I would quite frankly encourage those people to, people on this call, have those conversations, especially on the warehouse side. There's obviously been disruption in our space just as much as there's been in the origination space. Understand your bank's model, listen in on their earnings calls. How invested in the industry are they? And be willing to have those conversations, those hard conversations. If the bank is committed, you want to ensure and understand that your partners are going to be there for you as well. So, I highly encourage having those conversations with your partners to make sure that the people that you are choosing to do business with are going to be here and stand through those cycles.
I strongly agree with those comments, Colin. Now is a time where we can't be shy to ask tough questions. Knowing exactly who our partners are is critical. And I think that your best partners are going to appreciate you asking the question, because
Exactly.
they want to know that you know, and that's really very powerful right now. That's all great. Moving on to the second question, and I know a lot of great things are going to come out of this. Are there any emerging trends or innovations in the mortgage lending marketplace that have the potential to impact the liquidity dynamic? How can lenders adapt to those changes? Erin, did you want to start on that one?
Yeah, absolutely. So, I have three that I'd like to kind of touch on. One is changing counterparty requirements. Not only have we seen where our counterparties have left the space, but we've also seen where they've made drastic changes in their requirements. Chase, for example, going to 10 million net worth to be, delegated conventional conforming. Obviously, Fannie Freddie have had capital requirement changes. And so, I think that if you are currently right now walking the line of where your own company liquidity requirements, your covenants are, I think you need to be really careful, because those could change at any moment. You need to be prepared for things, especially on the IMB side, because we are looked at so closely. I think that you need to be prepared for not just what are today's requirements, but how can you make it so that you meet the challenges that are to come as things. I think it's going to continue to be tough through 2025, quite honestly. So, the next 12 to 18 months, are you able to adapt to requirements getting even tougher? Another thing, obviously, we're seeing on repurchases, that's been a really big issue, and it's a really big liquidity challenge. I recently had the ability to spend some time with Freddie Mac and discuss the challenges for those of us like us who primarily sell to the aggregators. If there is a repurchase agreement, it just kind of gets pushed down on us. How are we, as the original lender, able to be involved in conversations surrounding repurchase and work at other options outside of repurchase? And so, Freddie at least indicated that they are in favor of us being more involved in those conversations when we sell to aggregators. And so when you're facing repurchase, one, try to see if you'll be able to, if you can actually have the conversation with the aggregator themselves, or with the GSE, because potentially you can talk to them about options outside of repurchase that maybe don't cause you to buy a whole loan back. I know Freddie said they were interested in talking about those. So on the repurchase side, just be a little more involved in those conversations, and ask more questions. What alternatives do you have outside of that? And then, something I think just looking forward, as Greg said, people are expecting rates to drop. They're not going to go back down to 2s, but if they do drop, like everyone is fully expecting them to happen, you need to be prepared for EPO risk. Especially if they drop precipitously, your EPO risk is going to be a thing. So what does your loan loss reserve look like? Are you prepared for that? Do you have LO comp agreements in place that allow you to recapture that if you get hit with those? I think EPO risk is going to be a big problem for us if we have a marked decline in rates.
Agree. Colin, what are your thoughts?
Yeah, certainly. No, I think Aaron's really touched on a lot of them. A few of the ones that I'd highlighted, really, obviously, I think one of the biggest ones, particularly in the last quarter or two, has really been the repurchase side. And Aaron, to your point, really, a lot of that seems to be focused around Freddie Mac. So I'm encouraged to hear that there's some good ongoing dialogue there. Understanding with those repurchases, what is your process around that? How do you handle those? Make sure that you have a process to effectively manage through those as best as you possibly can. Another trend I think that maybe hasn't necessarily emerged, but I think has the potential to become something the longer we stay in this prolonged higher interest rate environment, is servicing advances. Generally speaking, the closer we get to a real true economic downturn, there is significant propensity for an increase in servicing advances. And so how are you managing those? Do you have particularly if you're servicing the asset, a tight process for how those are being managed, and are you staying on top of those, making sure that if you do have anything to file with any of the agencies, that you're handling that process immediately as soon as you're able to do so. Obviously, M&A, wind down, bankruptcies, it's prevalent in the industry. I think there were some articles that came across this morning that, there's probably another 60-ish deals that either have or are going to happen through the rest of the year, probably a little bit more on the quiet side. What does that create in terms of potential opportunities? So, are there opportunities to pick up maybe an additional branch here or there, or take a look at other acquisition opportunities? Maybe you're out buying MSRs or selling MSRs. Explore those opportunities if they make sense for your overall business. And then finally, I think there's overall less velocity in the market. Have you explored ways to, increase the ability to pool as well as reduce your costs through maybe some additional products and programs that maybe a broker-dealer or investment bank might offer, such as a gestation program that might give you a little bit of added ability to pool for a longer period so that you can get better execution in the market.
Greg?
Yeah, I'll take it a little bit different spin, but it certainly impacts liquidity. It's certainly something I've observed. I'm sure many other secondary folks have as well. Is that, I think we all know that the regulator of both Fannie, Freddie, FIFA has gotten very aggressive in affordability goals, which is great, but they're very, very challenging to meet, quite frankly. And so what we're seeing is that the aggregators have come off their pricing because they are struggling to meet the requirements of those affordability goals. So the simplest way to do that is reduce your denominator. So the numerator goes up and your overall percentage of that numerator is higher. And so what does that really mean? That just means that the aggregators have effectively priced back their normalized production, non-affordable lending type production. So trend we've seen, I've certainly seen other peers of mine have seen is that there's more and more trades that traditionally would go to aggregators when they have an implied really aggressive MSR bid, now going to Fannie Cash. In our world, Fannie Cash is certainly MBS, but with co-issued partners. So kind of expanding this evolving trend, expanding on this been through the servicing marketplace on Fannie side and Freddie's version as well. Having as many of those MSR buyers involved as a partner is incredibly important right now. I'll share numbers in our shop. We've seen literally 3 months ago, we would sell 5, 7, 8% Fannie Mae. This last trade, we sold 46%, and it has everything to do with what I just told you right there. It's just the aggregators cannot get aggressive enough. They're not as aggressive in their MSRs, and quite frankly, they're also, again, back to this, they were a little bit worried about refinances and prepays on the. We talked a little bit about EPOs or early payoffs, and so those are going to become very real very quickly if rates do fall. So, I think it's really important, if you don't already have a direct relationship with Fannie or Freddie, God, it's incredibly important. And I would also add, we may touch this a little bit more. I know Colin has some comments on this, and Aaron as well, around servicing retention versus servicing release strategies. So, in my world today, you don't return servicing. We're getting ready to have the ability to retain servicing, because you can have a COVID event and there's no bid in servicing. So then what do? You want to be able to, you always want, I know the three of us always think risk ahead, what can go wrong. And the most important thing you do is to plan for what can go wrong. Just, again, I just want to reiterate the importance of having as many investor, aggregator, and agency relationships as you possibly can. It really, really helps you through this kind of volatile and liquid time.
That's awesome. And it's a great segue for our next question, moving into risk management. So from a risk management perspective, what are some key indicators or metrics that lenders should monitor to assess their liquidity position? Are there any early warning signs that lenders should be aware of?
Yeah, certainly. I'll kind of lead this one off here, Pam, and I'll give you the perspective again. Generally, where warehouse banks tend to lend, and a lot of the third-party due diligence firms recommend, especially if they're coming in to, give you some sort of an assessment on your overall business. A lot of the industry best practices that you'll hear out there, there's a few different ways to look at it, and it really ultimately depends on what your ultimate business model looks like. Are you purely origination only? Do you retain servicing and have some sort of a servicing book? Or, really are you predominantly servicing and your origination business is there for recapture, right? Some of that guidance generally tends to be 30% of your cash 30% of your tangible net worth should be in liquid cash, whether that be on your balance sheet in some sort of a marketable securities account, or some will even consider cash that you have tied up in equity in your loans held for sale as a way to measure that because of the short-term nature of the business. Another one that I've heard out there, if you're really purely on the origination side, is you should maintain 175 basis points to 200 basis points of your average monthly production in cash as a means to look at liquidity. I generally like to bracket those and take a look at what those numbers mean and do they make sense for the client that we're looking at. One other thing that you have to consider, especially if you're on the servicing side, is understand your actual to actual or scheduled servicing remittance payments. If your servicing obligations are going up, what is the overall composition of your servicing book, and what potential strains could that put on liquidity as well? So do some testing around that as a means to be able to manage cash in your business appropriately. I know that in this market, we're scraping for every basis point that we can get. But to Aaron's point earlier, if you haven't already, develop a repurchase reserve or an allocation for repurchases. to help protect yourself, going through this current market where, repurchases are definitely on the rise. Develop a cash flow model if you haven't done so already. 30, 60, 90 days. Generally beyond that, it becomes very challenging to project cash, and your projections become less reliable. But at least in the short run, based on your pipeline expectations, try to develop that cash flow model and then test that model through various scenarios. And then finally, the big piece here is just communicate with your partners what your strategy is around your liquidity position. Cash is king in this business. It's the number that everybody focuses on, and rightfully should. Have a plan, communicate that plan regularly and often. I would say the relationships that we develop with our clients that are the deepest are the ones that it is a two-way street with communication. We are able to be better partners and help our clients navigate those challenging times when we're having that proactive two-way communication back and forth.
I'll be short on this one because I know, Pam, we have a certain time constraint here, but echo Colin, one of the things most important to me doing this for a long time, I have a lot of great relationships, is make sure you maintain those relationships. Talk to your investors, talk to your warehouse lenders all the time. Tell them what you're doing, what your challenges are, what your successes are, and where you see your opportunities. Trust me, they want you to be successful. They do not want to see you fail. So work with your partners, even including vendors. Work with your vendors too in these times. They want you to succeed. Talk to them about renegotiating contracts. It really is. This isn't so much a risk thing, but it certainly is an expense control thing. We've all been through the pain of having to have layoffs. No one likes to have layoffs, but really understand where your expenses are coming from, where your cash flow is going, etc. And again, just maintain good, positive, transparent communication with partners.
I feel like this question specifically is a game of yes and. So what all they said, so for me, just a couple other things to look at, and this might be obvious, but look at your locked pipeline. Are you up from last month? Are you down from last month? That's going to be a big difference in when your expected cash flow is, that you're, diving into that cash flow model. And Colin, I actually was on the phone with my CFO on the cash flow model this morning, and I'll be back on this afternoon. So concur.
That's great.
Also with your hedging, things to look at is again, the overall interest rate environment. Are you coming up on a Class A settlement with a couple $100,000 you're going to have to wire out one day? Making sure you're understanding that. I mean, that impacts where you're planning to be from a liquidity standpoint outside of your day-to-day expectations. So make sure you understand what your settlements look like. And then also, your QC feedback. This might be not an expected answer for this one, but I think you also need to be really looking at your forms of QC. So be it your normal standard QC reviews, your investor feedback, all of that. Because if you're starting to see trends where you have issues, that's just going to continue to get more and more expensive for you. And there's a problem in your manufacturing process that you need to dial in. So as a leader in your organization, don't just be a passive consumer of your quality control feedback. Make sure you're actively participating in it, actively asking questions, and actively understanding what your company and what you are doing to try to improve those findings so that you can reduce any leakage you might have.
One more thought there, Pam. I'm sorry. And then I got Aaron. You threw something out there. It's just I had to throw out fair value accounting treatment. No one really wants to talk about accounting, but fair value accounting. Everything that Aaron said there, you need to understand every impact of fair value accounting. It all works great. You can maintain great margins, but if your pipeline's going down and not going up, your fair value is going down. So you could be doing all the greatest things in the world, maintaining expenses, maintaining margins, but if your pipeline's dropping, your fair value is going down, and you can't not make accounting net income. It just doesn't work. And so, all of us on the capital markets and operational side have to deal with that reality. And it's the end of the month is always an interesting time when it comes to fair value accounting. So, especially when you're looking at your lock-in flow, that if it's flat, it's probably okay. If it's rising, you are okay. If it's going down, not so fun. But it is a risk. And it's an accounting risk that we all need to be aware of and very, very much pay attention.
That's all brilliant. I'm loving this webinar. The tactics and the actual detail that y'all are giving behind these answers is super impactful to our attendees. This webinar is being recorded also, so it'll get shared over and over again. So thank you for your brilliance. I want to move on to a balance type question. Because we've talked about risk, and we've talked about trends, and we know liquidity is a challenge, but how can lenders strike a balance between maintaining adequate liquidity and managing risk? And also, I want to throw in there, like, while we're being competitive, because we're in a super competitive market. Who wants to run with this one first? Erin, go.
All right, hey. So a couple of things here from a lender's perspective or an IMB perspective is one, capacity models, right? So, you know, really dial it in. I think capacity models go hand in hand with cash flow models and understanding where you can flex your staff in multiple roles to account for fluctuations in volume, right? So, you know, at Loan People, we have several areas where we have staff trained to do multiple roles. So we've been able to, you know, that helps us scale, and it's allowed us to kind of, you know, flex in different and not have that big ebb and flow of hiring and firing. We're able to try to keep more of a consistent employee base, and that obviously helps in your liquidity position. We've also looked at where can I turn costs into variable, but still to the risk perspective, make it make sense for the organization. So one thing we've done is we have a couple areas in the organization where we have one key employee, but then we have an outsourced vendor that can help flex and take additional capacity. So this person from a risk perspective is still looking out for Loan People as number one, still has our best interest, is still, you know, hand in hand with our business planning and who we are, but they have additional help that allows they need to keep part of that cost variable. And another thing is, I think a rigorous vendor management process is key here. Every vendor should be assigned a relationship manager, and every single year, if not more often, that relationship manager needs to be held accountable for essentially reevaluating the need for that vendor. Are you getting your money's worth out of that vendor? Are they providing the service level that they need? Can you renegotiate the cost? Is there another vendor that we need to go to? Are we even still using this vendor, right? I think this is one thing we in the mortgage market have done terribly at, is we just get on all these vendors and then we just keep paying them and we keep renewing contracts and we kind of lose sight of it. And so, you know, part of our vendor management process is there is an assigned account relationship manager internally, and they're accountable for making sure this vendor still makes sense for us, because that's a real easy way to lose a lot of money, is to not know all the vendors that you're paying.
Yeah, no doubt, Erin, and I'll keep mine pretty brief, but you know, I think through this time, it's very easy to focus on non-revenue generating staff as a way to maybe try to reduce cost. I think on the LO side, you know, there's probably some natural runoff from producers maybe that don't produce as high exiting the business. But with regards to your maybe non-revenue generating staff, I think an easy way to really explore that is, you know, is reducing my staff and opening up my manufacturing process to repurchase risk worth the cost of reducing the headcount in that particular department. And I think an easy way to look at that is, what is the cost of my capital from a repurchase, having my capital tied up in that repurchase loan, rather than out there making additional loans for me to get me over the hump of the fixed costs that my business incurs. What is that true cost of capital relative to the overall cost of maintaining that employee, or potentially keeping that employee but restructuring their compensation in some form or fashion? I think that's an easy way to capture and really measure and help make that determination regarding that side of the business.
Yeah, and just a slight twist, really more focused on our employees and loan officers. I mean, it's an interesting time for all of us. It's really important for your employees to understand how your firm is doing financially, how you're fighting through all these things we're talking about, and being successful. You know, celebrate your successes and make sure your employees understand that. You know, we get, Pam knows this, we get reverse inquiry for loan officers. The loan officers are hyper critical for our success in this, and maintaining your current fellow base and recruiting the right people that fits your culture is incredibly important. And again, maintaining, my perspective, maintaining your ability to have lock flow, origination flow, your infrastructure you built. And Aaron, you mentioned briefly just on capacity planning. Just think back, dig deep. Your employees, your greatest asset. Make sure they're aware and they're confident in their management team and what you guys and what your strategy is.
That's awesome. Okay, in light of recent market disruptions and regulatory changes, what are some strategies or measures, and again, going back to the tactic, strategies or measures that mortgage lenders can implement to proactively mitigate liquidity challenges and operational resilience?
Yeah, I'm not really a tech guy, but I'm going to take 2 minutes on this. Just I'm really passionate about this is really spinning back to capital markets. But we have a vendor we use for our hedging and interest rate risk management, and they allow us through their system technology to assign trades as part of our trades. And so I'm not here to market who they are, but I can just tell you assignment of trades in the market that's going to be liquid is incredibly important. So this will mean not a lot to most people, but the way bonds traded are called bid offer spread. And historically, that's usually like a basis point. These days, it might be 12, 15, 25 basis points. That's a hedge cost. And if you can assign a trade that you've already entered into and not have to pair off, that saves you a lot of dollars. And so that component of technology, and obviously things on the origination side, leverage technology, stop there.
Aaron, do you want to jump in?
Yeah.
AOT, I completely agree. That's a huge one that we employ whenever we can. Just a couple other ones that I had. One, vendor payment frequency. If you think that you're kind of going through a skinny time, a lot of times vendors will work with you and maybe they'll give you a discount if you pay annually, but if you want the opposite, sometimes they'll allow you to pay quarterly as well. So I've found that during this time, vendors have been just wonderful at working with us. Also, your lock policy. So we revisit our lock policy every 90 days at a minimum. And so some of the things that we look at is, what is your extension policy and what are your extension costs? Greg talked about roll costs. Well, are the costs that you're charging to extend locks in line with what you're seeing in the market for roll costs, right? So you need to, if you're charging a basis point a day, that's probably not an appropriate cost right now, right? So is what you're charging for extensions make sense? Is the amount of days you're allowing to extend make sense in this market? Long-term locks, are you hedging long-term locks? And if you are you accounting for your extended roll fees there and your carry costs? What's your renegotiation policy? Does it make sense? Is it making you lose money, right? Renegotiations are great. We want to keep the loan, but not if we do the loan ultimately at a loss. So really being dialed into your lock policy is something that we focused on a lot because that's where you can easily lose a lot of basis points. I know I'm probably speaking Greg's language here, but that's one we look at a lot. Another thing, Colin also touched on this, so hopefully I'm not stealing his thunder, is just warehouse funding. And, you can change the amount of percentage of haircut that you're taking when you fund loans on the warehouse. So maybe you fund almost 100% your first few loans of the month and, a couple $1 million, you can earn the interest rate spread on that. That's awesome. Or, maybe if you're more concerned about, having as much cash as possible, you just do a smaller haircut on every single loan. It helps bring in more money, especially in these high interest rate environments where you're earning that spread. And, you're also, allowing, giving yourself some more flexibility in terms of what you have in cash versus, what's on the balance sheet as loans held for sale. So a couple of things for me. Hopefully I didn't steal any of your stuff.
No, in fact, that's one point I'm just going to add a little bit more to that. You're exactly right. I mean, historically speaking, the last few years, excess liquidity on the balance sheet, it made sense to invest in your loans and really on the top line, right? Banks aren't paying anything for deposits at the time. So why wouldn't I take my cash, invest in my loan and earn the premium on my cash that I've invested in that loan in a short-term, standpoint? Now you look at it and it's where is my overall interest rate on the loan relative to the rate that I'm being charged on my warehouse line? Am I either in a positive spread or a negative spread? And now, if I have excess cash, investing in your inventory, it works both ways, not only on the upside, But now you've got to look at, okay, what is the rate that my bank is paying me on my deposits sitting on the balance sheet versus the cost I'm being charged on my warehouse line? And is it make more sense for me to invest in my loans or to earn the interest on those balances sitting in an account somewhere? So all just things that you can be strategic through different cycles on how to manage your liquidity appropriately. Couple other just real quick points that I think I wanted to touch on. Where can I unlock value in my balance sheet, right? MSRs historically, generally speaking, people have retained quite a bit over the last couple of years as interest rates have gone up. Do I have the ability to go out and either market that book for sale and take advantage of where the multiples are currently in that market, if it makes sense for where my book is, or can I go out and strategically leverage that asset? The same I think you could also say for the loans held for investment. If you have repurchases, do you have a clean book of business? Do you have the right people that you can talk to get access to maximizing the value that you might get in a scratch and dent bid, versus just going single-handedly straight to one of those particular investors? I think is something that's always important to keep in mind. And then, I look at that and I say, okay, is my capital tied up in that loan held for investment make sense for my business model? Can I afford to do that? Or should I look at, even though I might sell that below par, does it make sense for me to release that capital that might be tied up in that long-term asset? Just understanding what works for your business model, have a plan, communicate that plan, reassess that plan consistently. I think not having a plan in times like this is honestly more detrimental. Finger in the air, which way is the wind blowing, is more detrimental to your business than having a plan that, hey, we tried to execute, it didn't work, we tweaked it, and it's working for us now. The last thing again is looking at pooling velocity. Is there opportunity for additional financing that might be at a lower cost that would enable me to pool loans if I'm going agency direct, particularly to Ginnie Mae? If I'm a Ginnie Mae seller servicer, that I can tap into to maybe alleviate some of the costs around my warehouse and lower my overall cost getting those loans into pools. I think are very valuable places to look.
One quick thought too, Pam, and something Colin said. I want folks to know the impact of repurchases, the scratch and dent market. So one of the things that's incredibly important, we're talking about managing expenses, cutting costs, etc. Don't overcut your capacity. Underwriting quality is paramount in this market. And so if you unfortunately have some issues and you have some repurchases, we all know Fannie and Freddie have been pretty aggressive in that front. The reality is the cost of cutting an individual or two is way less expensive than having to sell a loan in a scratch and dent market. That market used to trade somewhere in the 90 to 95 range. It could be as low as 60 now. So think 67, depending on what coupon you're being asked to repurchase. It is a significant cost. So you have a 30-point cost on a $300,000 loan, that's 90 grand. It's not small dollars. And so the important thing there is, however you're thinking about what you're doing with your firm and capacity, just make sure don't give on quality.
Great.
That's so good. Well, we're at 11:53. Carol, we have another prepared question, but do we have any questions from attendees? We want to make sure we get those in before time.
There are no questions at this time.
Don't be shy, guys. Ask your questions. With there being none at this time, I'll finish up with a digital platform fintech question. Given the evolving landscape of mortgage lending, including the rise of digital platforms and fintech solutions, how do you see liquidity dynamics changing in the future? What are some opportunities and potential pitfalls lenders should be aware of?
Who wants to start? Go ahead, Aaron.
I mean,
I don't have much on that one, Aaron.
Aaron, since you're Carol Burnett. So like, go Aaron, go.
So who's the nose? I forget who does all of the things. Who knows? I'm calling a strike. So, I think really we all, it's the shiny object syndrome, again, I alluded to earlier. Like, just be really careful who you get involved with. Make sure that if you're signing up with a vendor, like, you really vetted it out, because we just spend dumb amounts of money in this industry on platforms that just get pushed out to salespeople who don't use them. And I will tell you, sales loan officers are ninjas at not doing what you would like for them to do, right? So like, make sure if you're giving them a system or a platform, it's something they truly want to do. Otherwise, you're going to be throwing your money down the drain. One thing we've looked at is like, how can we use like AI models to help? I think specifically like in the forecasting, and we're actually looking at it in a few different areas, but like, hey, can I leverage AI to help dial in and make my forecasting a little more tuned in, a little bit more quick and nimble, things like that. So who knows, we're just kind of toe dipping in it. But those are some things that I'm interested in.
Yeah. Few extra points just to kind of tag on there. Obviously, I think, FinTech is shared in its struggles as well through this market. So, I think that was a big topic of concern a few years ago. I think it just goes to show that everyone's susceptible to the same market, kind of through all this. But as it relates to technology and the adoption of technology, my biggest recommendation to people is really make sure that you've got a full understanding of the fixed versus variable cost associated with that technology adoption. Is there a high fixed cost associated with that? And can my volume really support managing that fixed cost through all cycles, and at the very least be able to cover that fixed cost? And then, again, where can I leverage existing partnerships rather than finding a bolt-on feature or implementing something new? Do my existing technology partners already have a solution that may not be as cost prohibitive or as expensive than trying to bundle some of those services with an existing partner and maybe getting some sort of a discount through that possible negotiation process.
That's awesome.
I'll just throw in there my neophyte ChatGPT guy. It's an evolving technology, but it's real and it's here, and we all need to be thoughtful about it. I mean, think about complex underwriting situations where you have to go look at 5 different underwriting guidance or something to that effect. Or if you have some kind of AI that can just up in the question, it just does that for the underwriter. It greatly enhances efficiency, understanding the risk and making the right decision. Also, we are just starting on a robotics project, so where you have a defined process where nothing really changes, it's just a process. You can deploy robotics. Robots don't sleep, and these aren't like real robots; these are computer robots. But it's a real technology out there, and it really does work. But you got to make sure when you look at it, you focus that it's a really pretty much standardized process. It doesn't work real well if you change the process, just so you're aware. But I do really fundamentally believe in AI, and it's going to change up this industry over the next several years. So we can't stick our head in the sand because it's real and it's here and it's not going anywhere. And I'm a big.
So general consensus from the panel, what I heard today is that some of these liquidity challenges we're facing are they're here, and they're going to be here for a minimum of another 12 months, maybe a little bit longer. Does anybody want to opine about what markers or metrics we'll see that will be the beginning of the change?
Well, are we going to go to a recession? that chatter's changed things up a little bit. I mean, look, at the end of the day, if we get some Fed, it's honestly for our business right now, it's all kind of driven by what the Fed does and what the underlying economy does in inflation. That's the reality of life. And yeah. I fundamentally believe myself that we will see rates lower at some point. Is it going to be in the next 3 months? Maybe not. But I certainly see over the next, say, 12 to 18 months, certainly yes. And so, you got to set up your teams to be ready for that as well. For that sea change. Reaching out today, you may not have an opportunity for refinance today, but you may have one certainly in the next months. So, to me, the fundamental of just the rate change and any uncertainty around the economy will help. It will help define liquidity a bit better. We're just not there yet.
To add to that point, just a real quick tack on, I think you're right, Greg. The biggest thing I would just recommend to people is don't bank on refinances being your savior. You know, market rates have to be at least 50 basis points below for the borrower to maybe make sense. And I'm using very general numbers there, but you know, how deep would a cut in rates go relative to your client base and the book that you're working of relationships? You know, just I see it as an ad, but don't maybe necessarily make it your one savior that you're throwing your entire hat into the bucket on, especially when majority of loans in the country are, you know, 80–90% in the 3 to 4% range.
Yeah, you know, I'm looking at, you know, the money supply, how much money is out there, and I'm also looking at employment numbers. I think the Fed is honed in on where that employment market is. So until we see any kind of softening there, I think we're in it. This is our new normal.
Well, panel, I can't begin to tell you how much I appreciate your time today, your brilliance, and your detail on these topics. TMBA continues to work to bring great webinars just like this one to everybody. Please check out the homepage at texasmba.org for the upcoming schedule, and watch for emails from the TMBA so you can get more phenomenal content like you did today from these experts. I appreciate you all so much. It's 12:01. We're at time. Thank you. You did a great job, and we'll see you soon from the TMBA.
Thank you.